Good morning, good afternoon, or good evening, depending where you are on the planet. And welcome to the Monday, the 7th of April, Bull versus Bear webinar. Steve Miley here on the call for Trade Day. Welcome, everyone. We're going to go for our usual weekly run through in here where we take a slightly bigger picture look at markets. I'm going to concentrate on stuff, but clearly it's all about the price action in relation to the big sell-off that we're seeing due to the tariffs. So no matter what we have outside of that, that is the critical key focus for the week, despite the fact that we've got some insignificant events coming up this week. So as much as we need to continue to have an eye on data and central bank, potentially the Fed. The Fed's the one that we really need to watch now. A lot of murmurings of emergency rate cut. The Fed are not here to rescue the stock market, but equally, there are obviously the stock market selling off due to the fact there are massive concerns around not just inflationary pressures, but more now recessionary pressures. That the tariffs are going to significantly hit growth and cause a US and potentially global recession. So all of that is to be taken into consideration. And so some eyes are on the Fed. But we'll run through, we'll do our due diligence anyway. The main reason I'm on this, not so much for the calendar, because the calendar is one kind of irrelevant to the extent at the moment, the data calendar. The European data is not going to do anything. And there's nothing of note at the US today. Consumer credit for February at 3:00. It's very backward looking. It's not going to make any difference to the market. It's not a big number anyway. So it's all going to be about anything we get from potential negotiations on the tariffs, or whether we get more tariffs, further tariffs coming in from other countries, whether we get some kind of further retaliatory, given that we've already had China retaliate. Does then the US retaliate and up tariffs again on China, or is there some moderation? So all of that is we're watching anything coming out of the Trump cabinet, anything coming out from Trump, anything coming out from the White House, and also anything from the central bank, from the Fed. So nothing really on the note, but the main reason I wanted to come here is this in here. We've had this up since last Wednesday, or since Thursday. FAQ and price limits and circuit breakers giving heightened volatility. Here's the FAQ in here. I'm going to share it into the chat. You can go into our FAQs, just type in limits or breakers or circuit, and you'll get the FAQ. I just put it into the chat, the live chat. So basically, these are put in place. They're in the cash market, but they're also mimicked in the futures markets. If the market moves 7%, so this is the S&P or the Dow or the NASDAQ, if they move 7%, 13%, or 20% from the previous day's settlement price. So you can just look at what the market change is, what the percentage change is. So if we get a 7%, 13%, and 20%, and the CME, if you go and click, it tells you where these are, where you can click in. We've got links in here so you can go and see where they would kick in. So they're 7%, 13%, and 20%. And at Trade Day, what we ask is if you're in the funded trader, so if you're in a funded SIM or a funded live account, you do not trade within 2% of these circuit breakers. So that would be 5%, 11%, and 18%. Because there is a risk then if you get caught, the market's 5% down and all of a sudden it jumps to 7% down, you can get caught in a trade. If you get caught long or short and you're not out, then that puts Trade Day at significant risk, okay, in a funded situation. Puts your account at risk and Trade Day at risk. If you've got an open position, the market closes, it closes then for, where are we? It's 10 or 15 minutes, I can never remember. 10 or 15 minutes, and it reopens. Where are we? 15-minute trading halt. And then it reopens. And if it goes to if it opens immediately at the next circuit breaker, then the market will close, literally open for a second, then reclose immediately, right? So it doesn't effectively trade, and then just immediately closes again. So it puts obviously Trade Day at risk because the market could jump X%, and then you could have an open position if you're long and it's going down. Obviously, that's the risk at the moment. If it's 5% down, it jumps to 7% down, you're in a position. So we ask you not to trade if we're in two. Now, this 2% of a price limit, so that's 5% down on the day. Now, this morning, certainly the NASDAQ was over 5% down on the day, and I think the S&P was very close at one point. We've obviously bounced back. We're not obviously, but we have bounced back from those extremes already this morning. But if we get to within 5% down on the day on any of the indices, you need to stop trading those markets, please. If you're in a funded account, okay, I'd highly recommend if you're in a even if you're in a evaluation, you stop trading, because if you get caught and you can't get out of the position, the market closes, you're in a position when it gaps if it gaps lower, and you're long, then you're going to blow your account, kind of stuff, almost immediately. So when the market reopens. So enough of that lecture, but please do be aware of that in these current volatile times. Let's go and take a look at our macro watch. I mean, there's not, obviously markets got absolutely the macro watch and the macro matters. Go and take a look at those. But some of the numbers are quite scary. We were 9% down last week on the S&P. The Nasdaq was 10. The Dow was 8. The Nasdaq is already in a bear market. That means it's 20% off its peak. Okay, the peak from early this year, I think, or late last year, early this year. The Russell has entered a bear market. The Russell 2000 is 20% below its November high, so that's an official bear market. And last week, the 10-year yield dipped below 4% for the first time in 6 months. So yields are going lower, bonds are going higher as an ultimate safe haven. It's not just in the US. Obviously, this is a global phenomena. So we're seeing significant losses. The German DAX and the French CAC lost over 8%. The Japanese Nikkei 9% last week. And the Hang Seng also notably lower. And then the Hang Seng also getting, and the Asian markets getting beaten up significantly again this morning. Obviously, it's all on these tariff concerns. Also, China counter tariffs are driving all this. US employment report on Friday was actually better than expectations, but it's obviously backward looking pre the tariffs being put on, and obviously the market pretty much ignored the fact that was better than expected. If we look ahead to this week, we've got the Fed on Wednesday, we've got US inflation data on Thursday, and then earnings season kicks off on Friday with the banks. So we take a look in here. Fed minutes on Wednesday, they're very backward looking, so we're not going to get anything out of those, right? They might just say, watching the potential impact from tariffs, but really they're not going to tell us anything really new on Wednesday. But remember, they are one of our embargoed pieces of data, so that we will close the market 2 minutes before and after those, as is the US CPI data, which is the main data of the week in here, coming up on Thursday. And then if we skip to the earnings report in here, we get really earnings season kicks off properly on Friday with JP Morgan, Wells Fargo, Morgan Stanley and BlackRock all reporting. So it's a busy second half of the week, Wednesday through Friday, Wednesday Fed minutes, Thursday CPI, Friday earnings reports. But equally, all the focus is going to be anything coming out of either the US government, on tariffs, anything coming out from the Fed on tariffs, and anything coming on overseas governments on tariffs. There's the earnings calendar, just by the way. And then obviously next week we really get into earnings. Now, remember, obviously these earnings are not going to be significantly impacted negatively by the tariffs because we haven't had a chance, and they're looking back to the first quarter before the tariffs were put on. However, what's going to be really important to watch out for is if any indication, there's going to be, I'm sure, a lot of these big tech companies in particular revising their forward revisions potentially because of the tariffs. And, they're going to be saying, well, that we don't know what's going to happen, right? So I think the forward guidance from in earnings season is going to be super important. Looking at normally I wouldn't be focusing on this right now. The next Fed meeting is not till the 6th, 7th. Now, I'm going to jump there. I'm going to pull this along here. But you see here the May meeting. Remember, only pre last Wednesday, pre-Liberation Day, which I'm putting in quotes, Free Liberation Day, as it's been called. I don't know who it's liberating, but there we go. But then pre-Liberation Day, this was down at like 5 or 10%. Creeping into Liberation Day, I think it was up at 20%. Now we're up at 44%. There's now gone from almost a 0% chance of a rate cut in here in the May meeting to now 44% chance that we cut rates either at the May meeting or before. And there's chitter chatter in the markets around emergency rate cut. I don't think we'll get an emergency rate cut. I don't think the Fed will act before May. I do now think they will act in May. with at least a 20. Well, it's showing here only a 25 basis point cut, but who knows if they go bigger than that maybe in May. So chances of that. And then not only that though, but we get to June, and we're now pretty much in here. This is for one rate cut for 25. This is for 50 basis points by June. So now that the market is not pricing in any chance of no rate cut. By June, we're pricing in 50-50 between 25 and 50 basis points. If we go to July, now we've got here, this is 50% chance, or over 50% chance we got 50 basis points. And by July, now there's almost at 50-50 that we get 75 basis points. And now by the end of the year, you see how this is linked up now. We're at 325 to 350, which is 100 basis points, 25 rate cuts, or a total of 100 basis points, or maybe up to 125 basis points. So between 4 and 5 rate cuts, or 25, 4 or 5, 25 basis point rate cuts. So between 100 and 125 being priced in. Remember, it was sitting between 50 and 75, between 2 and 3 rate cuts only a week or so ago. So the market are now aggressively pricing in more rate cuts because of concerns that the Liberation Day tariffs are going to lead to not only inflationary pressures, which obviously the Fed have got to be concerned about, but recessionary pressures in here. This comes in fully in focus now, the 6th, 7th of May. This is going to, what's going to be potentially a non-event now. It's going to be a huge event. And then what we're looking for are any clues from the Fed that they are willing to do that. I'm just going to refresh this because I didn't see. Okay. Here it is. Good morning. The Morning Briefing America. So Trump's takes unapologetic stand on tariffs as market collapses. Dismissed investors' fears of inflation, such as Viennese tariff plans unveiled last week. I don't want anything to go down, but sometimes you have to take the medicine to fix something. Wall Street isn't convinced. JP Morgan chief said tariff price issues need to be resolved quickly. Bill Ackman, ally of the president, said the levies are a mistake and urged Trump to call a 90-day timeout. Another hedge fund billionaire joined in on the criticism. Elon Musk called for a zero tariff regime between the US and Europe that would effectively indicate a free trade zone. So, a lot of calls for backtracking on this. It's not Trump's style to backtrack. So who knows where we go with this, right? Or whether it's just a bargaining tool and then we start getting bargaining its countries on trade and where it brings them to the table. But it's going to be interesting, to say the least, in here. Tension turning to the Fed. Buying bonds. Bonds are going up in price, down in yields. Goldman Sachs, UBS, and TD Securities pulled forward their Fed easing expectations, so the 10-year yield could drop to 3% now this year. Marcus Bet shows an expectation the central bank will cut interest rates another 5 times this year, from just 3 last week. This is what I just went through. Recession probabilities in here. So all of this, all quite negative overall. And just a load of headlines in here. Turmoil worsens as traders pin hopes on Fed rate cuts. Stock futures parry decline. So stock futures have bounced, as I just said. We were down basically 5% on Nasdaq and S&P this morning. When I was up, in the European, I'm in the European time zone. So on the overnights for you guys in the US, through the late Asian session, early European session, these markets were down like 5%. And they've rebounded back from there. We're now, a couple of percent down, I'm thinking here at the moment. Just double checking off screen. We're about 2% down, 2 to 2.5% down now. So markets have rebounded 2.5% already off of the lows. But nevertheless, when the cash market opens, we'll have to wait and see, right? Traders add to bets on 2025 Fed cuts with risk of an emergency move. I don't think that's going to happen personally, but who knows? The pricing in there, look, 125 basis point, 5 quarter point moves, and maybe as early as the May meeting. Tariff war sparks Hong Kong stocks' worst implosion since 1997. So markets are pretty much down. The moves last week were the biggest moves down we've seen since the pandemic, since March 2020, when the pandemic really broke, and markets sold off through that month. It's the biggest losses we've seen since then. And Hang Seng since Hong Kong stocks in here since 1997. And again, from Reuters, stocks plunge on tariff turmoil, markets bet on rapid US rate. That's all the same stuff. S&P eyes bear territory as markets worse. So we were 2.2%, 6% down, but Dow futures down 20% from the record. So they were down 20% in here this morning, I think. at one point. Let's see if we close. The definition of the bear market is usually closing 20% down. We haven't closed yet 20% down, but we have on the Nasdaq and on the Russell. European shares plummet to a 16-month low. It's all the same stuff. Hedge funds capitulate. Investors brace for margin calls as well. So that's a real concern and negative. And if we just do a run around the markets, 7.8% down on the Nikkei, 13%. That's effectively a mini crash for the Hang Seng this morning. 13% down this morning. European stock indices between 4.5% to 6% down this morning. 4.5%. UK FTSE, German DAX, and the French CAC between 4.6% and 6.2% down this morning. And US overnights in here. We have rebound, but say we were about 5% down on both the S&P and the Nasdaq at one point this morning. Currently down, if I were to get a refresh here, between 2.5% down so far this morning. Bond markets, as we said previously in here, we meant some new low yields last week. And then this morning, 10-year yield got all the way down to like 3.8%. We have rebounded in here, but still below 4% in here. And if we go to the analysis, all bullish, right? You can't be anything but bullish on the bond market. Looking super bullish still. And obviously stocks look super bearish. We've gone further. We're gapped lower. And let's go and take a look at the charts. So we had this big gap. We not only closed on the lows. Wednesday, we sold off post-Liberation Day. Thursday, a minor down day. Friday, a massive down day. Then we gap lower and go another 5% down. We have had an intraday rebound in here of like 2.5% off of the lows on both the S&P and the Nasdaq. Now, if we settle out here, if we close the gaps this morning, that could be the bottom. We could be seeing the bottom going in, right? Because we're significantly down, right? We're down at one point, we were down 15% from last Wednesday, 13, 15% from last Wednesday. And off the highs, depending if you look at the Nasdaq or the S&P, we're in bear market territory, down 20% off the highs. However, the rebounds we're seeing, if we see this candlesticks close out where they are right now today, they're kind of quite bullish candlesticks, right? They're rejections, they're hammer candlesticks, okay, which are a bearish rejection. If they close the gaps that we have, that's going to be important as well. So I think really what you're watching is the gaps. If we close the gaps through the cash equity market open, we could go significantly higher and start eating back into Friday's losses. So this is not all bearish. This could easily turn around. That could be everything priced in. We've seen the capitulation. We've seen the panic selling. However, on the cash market open today, you could easily see further cash market liquidation and see further losses back to these lows and maybe lower. There's still a lot to be done today. The market's done a lot today already. It's already moved effectively 7.5%, right? We've gone down 5% and back up 2.5%, 3% today. It could do a lot more. The journey could be a lot further. So, you obviously, guys, I don't need to tell you. I've been saying this since Wednesday. Keep your trading size smaller and top stops. You need to maybe let the stops go a little bit wider and have less size on, right? So that's the way, because otherwise you're going to get easily chopped up if the stops are too tight due to the volatility. All right, guys, I'm going to leave it there. We just have to say wait, and then obviously you should be watching all the social media feeds. Watching the POTUS feed. Watching so the POTUS, the Trump's own feeds. Watching anything coming out from the Fed as well, and then obviously overseas, watching the news wires, because this thing could start to move. You don't want to be fighting the price action. If news comes out, this could just spike in either direction quite aggressively. So you have to just being careful. There's a lot of opportunity, but there's also obviously a lot of risk coming with that opportunity. All right, guys, I'm going to wish you all a great trading day. Take care, stay safe. We'll be back with you tomorrow with another Bull versus Bear webinar. Bye.